As global markets enter a period of historic uncertainty, investors are shifting their attention to precious metals once again. Gold and silver have already shown signs of powerful momentum, but 2026 is shaping up to be a year unlike any other. With rising geopolitical instability, weakening trust in fiat currencies, and a rapidly changing economic landscape, many analysts believe a massive shift in global wealth is approaching. This report explores the core reasons why gold and silver may skyrocket in 2026, why the US dollar could face one of its sharpest declines in decades, and how investors can prepare for what may become a generational financial transformation. The world is quietly approaching a major financial transition. Over the last decade, global trade has gradually moved away from dollar dependency, and by 2026, this shift is expected to accelerate dramatically. Several major economies are exploring alternatives to the US dollar for cross-border transactions, reducing demand for America's currency. As the dollar weakens, investors naturally migrate toward assets that can hold or even increase their value during monetary instability. Gold and silver are historically the most reliable hedges against currency depreciation, which is why many financial experts predict a surge in both metals. The more global confidence declines in fiat systems, the more people seek refuge in tangible stores of value. Precious metals have survived every financial crisis in history, and 2026 may once again prove their strength. While many governments claim inflation is under control, the real picture looks very different. Behind official numbers lies a growing pressure in commodity prices, energy markets, and global supply chains. By 2026, this hidden inflation could become impossible to ignore. When basic goods rise faster than wages, currencies lose purchasing power at a dangerous pace. The US dollar, already weakened by excessive money printing during the previous decade, may finally face the consequences. As inflation accelerates, investors will likely move toward hard assets with limited supply. Gold and silver, unlike fiat currencies, cannot be printed. Their scarcity gives them natural resistance against inflationary decay. Historically, every major inflation cycle has ended with a strong rally in precious metals. If inflation continues its silent climb, 2026 could mark the beginning of one of the largest metal bull runs in modern history. One of the strongest signals of a coming precious metals rally is the behavior of central banks. Over the past several years, countries have been accumulating gold at a record pace, reducing their dependence on the US dollar. This trend is expected to intensify by 2026 as nations seek financial protection against geopolitical risk and currency volatility. When central banks buy gold, they effectively remove large quantities from the global supply, tightening the market and increasing prices. Silver, while often overlooked, tends to follow gold's trajectory closely. As institutional demand grows, individual investors start paying attention as well. Central bank accumulation also reflects diminishing trust in the long-term stability of the dollar. If major economies continue expanding their gold reserves, precious metals could enter a supply crunch that triggers rapid price acceleration. The US dollar has long been the backbone of global finance, but its foundation is showing signs of erosion. Rising national debt, declining manufacturing output, and increasing political fragmentation are placing pressure on the currency's stability. By 2026, these structural vulnerabilities may reach a critical point. When a currency begins to lose global confidence, capital flows shift rapidly. Foreign governments reduce their holdings, international trade partners seek alternatives, and global markets look for safer stores of value. As the dollar weakens, gold and silver naturally absorb the demand. Historically, the fall of a dominant currency leads to a rise in hard assets. If the current trends continue, 2026 could witness the dollar's largest value contraction in decades. opening the door for an explosive metals rally. Silver is often viewed merely as a monetary metal, but its industrial importance is rising rapidly. Solar panels, electric vehicles, advanced electronics, medical devices, and emerging technologies all rely heavily on silver due to its unmatched conductivity. By 2026, global silver demand is projected to surpass supply by a significant margin. When industrial demand rises while mine production stagnates, prices can move sharply upward. Silver also tends to outperform gold during strong bull markets because of its lower price and higher volatility. As the world shifts toward green technology and electric infrastructure, silver may become one of the most strategically important metals of the decade, potentially delivering extraordinary gains. Gold has always been a safe haven during economic turmoil, but the years leading up to 2026 carry a unique combination of risks. Geopolitical tensions, unstable debt markets, and weakening currencies all point toward increasing global uncertainty. When fear spreads across financial systems, investors seek assets that provide protection, liquidity, and long-term reliability. Gold's role as the ultimate crisis shield becomes more evident. Unlike stocks or bonds, gold carries no counterparty risk, meaning its value does not depend on the solvency of an institution. As global uncertainty rises, central banks and investors may aggressively accumulate gold, pushing prices to historical highs. A hidden but critical factor behind rising gold and silver prices is the growing fragility of global mining operations. Many of the world's most productive mines are aging, and ore grades have been declining for years. Mining companies face increasing energy costs, tighter regulations, and environmental restrictions, all of which slow production. By 2026, the gap between metal demand and physical supply is expected to widen dramatically. Silver, in particular, faces a structural shortage because most of its production comes as a byproduct of other metals. If base metal mining declines, silver output falls with it, regardless of demand. Meanwhile, geopolitical tensions can easily disrupt supply chains, causing sudden price shocks. When supply becomes unpredictable and expensive to replace, precious metals enter a phase where prices rise not gradually, but exponentially. The rapid expansion of digital finance may seem unrelated to precious metals, but the opposite is true. As digital payment systems grow, trust in traditional currencies decreases, and investors look for alternative stores of value. Cryptocurrencies may have captured attention, yet they remain highly volatile and unregulated. Gold and silver, by contrast, have thousands of years of trust behind them. By 2026, as digital financial infrastructure becomes more centralized and monitored, many investors may turn back to physical assets for privacy and security. Additionally, blockchain-based metal ownership systems are making gold and silver easier to trade than ever before. This blending of ancient value with modern technology could trigger a renewed wave of interest in precious metals. History repeatedly shows that geopolitical shocks have a strong impact on precious metals. Conflicts, sanctions, and economic fragmentation push countries to secure their wealth outside vulnerable financial systems. By 2026, rising tensions in several strategic regions may significantly influence global markets. As alliances shift and nations compete for resources, trust in international institutions may weaken. When diplomatic stability fades, investors seek assets that hold universal value, gold and silver. These metals act as a neutral form of wealth, unaffected by borders or political agendas. Should geopolitical uncertainty intensify, precious metals could experience rapid price spikes driven by fear and defensive positioning. Market movements are not driven solely by data. They are fueled by human psychology. Fear, greed, uncertainty, and herd mentality can move trillions of dollars in a matter of days. By 2026, as multiple financial risks converge, investor psychology may become the strongest catalyst for gold and silver's rise. When people believe a major shift is coming, they rush to secure scarce assets before prices climb further. Precious metals benefit greatly from this behavior because they represent safety and limited supply. Once momentum begins, media coverage amplifies the trend, pulling even more investors into the market. This feedback loop often leads to sharp, accelerating rallies. Analysts increasingly discuss the possibility of a metals supercycle, a prolonged period of rising prices driven by structural economic changes. Several conditions for such a supercycle appear to be forming by 2026. Shrinking supply, rising industrial demand, weakening currencies, and escalating geopolitical risk. When these factors align, markets can enter a multi-year phase where precious metals rise far beyond traditional expectations. Silver, due to its dual role, may outperform dramatically. Gold could break historical records as central banks compete to expand reserves. If the supercycle accelerates, 2026 may be remembered as the year global wealth began shifting from paper assets to tangible commodities. As the world approaches 2026, the signals of a major transformation are becoming increasingly clear. Weakening currencies, shifting geopolitical alliances, and rising industrial demand for metals indicate that a new financial era may be beginning. In such periods of uncertainty, preparation becomes essential. Investors who diversify into tangible assets, especially gold and silver, may find themselves far better positioned than those relying solely on traditional financial instruments. Precious metals serve not only as a hedge against crisis, but also as a bridge to long-term stability. The years ahead could redefine global wealth, and those who understand the shift early will have the greatest advantage.